Indeed, Pim, we've got Alan Sinai, the president of Decision Economics here. And while the Kansas City Fed's been hosting this conference here for almost 30 years, you haven't been here quite that many years, but you've been here, you were telling me, about 18 years. Given the buildup that this event, Ben Bernanke's speech to this event tomorrow has received, have you ever seen anything like that at this conference?
No. No, the buildup, the anticipation, and of course the press and the media. It's extraordinary compared to what it used to be in the early days.
It's always been sort of an academic conference, and now you've got a real practical concern.
Well, the people involved are more academic than used to be the case. Remember, the Federal Reserve has gotten very academic. The regional presidents, many of them PhD economists, technically trained, and the whole cast of the Federal Reserve, led by Ben Bernanke, who's a crack academic, is tilted toward academics, but with a mind toward applications of the academic stuff to real problems. And we do have a lot of real problems.
Do you think that the buildup and the hype surrounding Mr. Bernanke's speech tomorrow is justified? Is the Fed the only game in town right now? Does everybody have to pin their hopes on what he might tell people here for about 30 minutes or so?
I would get hopes too high because we are looking at some tough problems in the U.S. economy. Monetary policy, even as I think they will move toward more aggressive easing, more quantitative easing, isn't going to give us quick results. And fiscal policy is quiet now until at least after the election.
Well, what do you think is going to happen in the economy? What's your diagnosis at this point as to how ill the patient is?
Patient looks still pretty sick. We are tracking third quarter, this preliminary real GDP growth of just 0.3%. So statistically, it's not really different from zero or a small minus or maybe a plus of 1%. And we expect the report on the second quarter to be revised down into the ones. In the fourth quarter, just 1.5 plus. So we are flirting with a double dip in the here and now. It's very disappointing. And the fiscal policy stimulus is fading, and the Federal Reserve monetary ease isn't really lighting up the private sector. We have real problems.
The Fed's forecast has been for the economy to slow, certainly not as much as it is right now with the numbers that you're talking about. But they believe that as we get through the latter part of this year into 2011, growth resumes. Is that a fair forecast, or do they need to change it now?
I think the risks around that forecast are quite sizable, downside risks. For us, the chance of a true double dip, fall back to recession, 1 in 5. And then there's another kind of bad risk. We're like Japan, 15%, 35% downside risks on a scenario that is really much weaker than the Fed. So I think they need to take action to avoid the risk. They're a risk management outfit. They really should get more aggressively easier.
All right. Now, if they do get more aggressively, I got about 30 seconds left. What could they do that would actually have an effect on the economy?
I think they could cut the interest rate on excess reserves, provide an incentive to banks not to hold the money but to lend. They need to look out of the box for different ways to get funds, credit, into the economy where credit is log-jammed.
The banks say nobody wants to borrow.
No, there are a lot of people who want to borrow. The banks aren't that anxious to borrow, too much credit risk. And the supervisors are very tough on the banks. Supervisors ought to let up a little bit and let them lend a little more.
So bottom line is the Fed could have an effect if Ben Bernanke thinks it's necessary.
I think the Fed could have an effect. And remember, lower interest rates, low and lower interest rates with lags always help.
All right, Alan Sinai, thank you very much for joining us.
Mike.
We'll look forward to getting your reaction tomorrow after Ben Bernanke's speech.